Now we know that China is facing some serious challenges: declining exports, a slowdown in the property sector, muted consumption growth, and rising unemployment. Now all of these factors are really weighing on the economy. Now if you're interested in a deeper dive into China's slowing economic growth, you can check out one of our earlier videos. Now coming back to the story. Now while China's economy is faltering, surprisingly its stock market is booming. The Shanghai Composite Index has jumped 20% in just 5 days. This is actually the fastest surge since more than a decade. So what's behind this? Well, China has taken some big steps to boost liquidity and consumption. They've cut the reserve requirement ratio for all banks by 50 basis points, and they've also lowered the borrowing costs. That's not all. 3 out of China's 4 Tier 1 megacities have also relaxed rules to make property purchases easier. Now, these aggressive fiscal policies and rate cuts from Beijing are the driving forces behind the stock market rally. However, while China's stock market is surging here in India, this week it's been quite the opposite. The Nifty and Sensex indices have come under selling pressure, and foreign institutional investors pulled out more than $1 billion in a single day. Now, it's important to note that the boom in China's stock market seems to be more of a fear of missing out rally, and markets will always follow fundamentals. The policies have yet to fully take effect, so only time will tell if they will be enough to fundamentally fix the deep-rooted issues like the prolonged property crisis and the sluggish consumption, or if it would lead to more inflation. Now it's that time of the month when we get a flood of economic data releases, and first up is the fiscal deficit data of the Indian government. Now next up, let's break down how the Indian government finances are holding up. Now, a government's fiscal deficit shows the gap between its total expenditure and revenue. In simple terms, it shows how much more money a government is spending compared to what it's earning. And our government spends more than it earns, and it's all about decreasing that gap. Now, the fiscal deficit is usually calculated on a fiscal year basis, which runs from April to March. Now, typically, the government sets a budget target for the fiscal deficit during union budget, and every month the numbers are released to track how much of that target has been achieved. Now, reducing the fiscal deficit is essential because a large deficit indicates that the country isn't managing its income and expenses effectively. Now, coming to the latest data. As of April to August fiscal year 25, India's fiscal deficit stood at 4.35 trillion rupees, which is 27% of the estimate for fiscal year 25. Now, this latest figure is actually lower than the 6.43 trillion rupees reported during the same period last year. Now, the reason behind this is higher tax receipts, a healthy dividend payout from the central bank, and subdued government spending. Now, another important way to look at the fiscal deficit is by comparing it to the GDP. Now, the lower this number, the better it is for the economy. For fiscal year 25, the central government has set a fiscal deficit target of 4.9% of the GDP compared to 5.6% last year. Now, this target conveys that the government's commitment to fiscal consolidation goals, which is a good positive step. Now, overall, the government's finances seem to be in good shape for now. Hopefully, everything stays on track, supporting the economy in the right direction. Now coming to the core sector data. Now the core sector index in India tracks the performance of 8 key industrial sectors that are fundamental to the economy. Now these sectors give us insights into the production levels and in turn the overall health of the broader economy. Now for August 2024, the data shows a concerning trend. After 3.5 years of positive growth, the output of these core sectors contracted by 1.8%. Now if you look at this chart, only 2 sectors, fertilizers and steel, managed to report growth in production. On the other hand, the output of coal, crude oil, natural gas, refinery products, cement, electricity all saw a decline. Now think of these core sectors as the vital organs of the economy. They produce the basic necessities and key inputs that other industries depend on. When these sectors are doing well, it usually signals that the economy as a whole is healthy and growing. But right now we are seeing a decline, and this drop can be partly attributed to high base effect from the previous year and the monsoon seasons, which impacted industrial activity. However, in the long term, we remain optimistic. The government's capital expenditure plans are expected to stimulate growth in these core sectors. This in turn should boost the overall economic outlook for the country. So while the short-term data looks a little worrying, the long-term picture still holds promise. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.